I know that days like today can be pretty frustrating and hard to hang on sometimes. So I wanted to take a moment and just say, hey, where are we going from here? This chart in front of you, this page is put on by JP Morgan, and it's a great 42-year example of how the S&P 500 each year has had returns, which are shown by the bar on the bar chart, and have also had periods of declines every year. So the red dot shown with the numbers, well, that's the negative decline in any given year. And I just wanted to bring this to everyone's attention to say, hey, here's some things to think about. In those 42 years, the average drawdown in a given year is 14%. Now, markets are moving quite a bit right now, but as of yesterday, it was down about 14%. So we're right at the average for an average drawdown. The amount of times that it happened was 17 times out of 42 years. So that means that there's 40% chance of a 14% drawdown in the market or decline in the market or greater. So we all know this is coming and it's just part of cycles, but it does take our breath away from time to time when it happens. So the range that can happen is a huge range, right? We had times where the market had dropped 38% in those 17 years, but there's also times where the markets had increased at the end by 24%. So if you figure we're already about 14% down, it's saying, hey, where can we expect the markets to go? Well, it's a pretty wide range. It can be anywhere from 24% more down all the way up to 38% up. All of them have history in their favor to say, hey, here's an example of when it did this. It's very hard to incorporate the bond markets right now. And that's really what has hurt a lot of portfolios is rising interest rate environment that's combating inflation and that's impacting bond prices and valuations of companies. So I wanted to look at this chart and say, when was a time when we could say, hey, here's an example where we had some rising interest rate environment and rising inflation. So it was combating that inflation. And how did the markets do during those years? The best example I could find during this time frame was actually between 1987 and 1990. During those 4 years, basically, it starts off on this graph with a big bang because we had what was called Black Monday in 1987, where the markets declined a lot in a single day. And that dip overall was down 34% in 1987. However, the market still returned a positive number that year. It was up by 2%. If we averaged all the years of 1987 through 1990, during those rising interest rates, rising Fed funds rates, and rising inflation, the average return was 8.5%. So you would have received 8.5% year over year, or if you held on and got through those years, your portfolios would be a little over a third bigger. So there are indications where even in rising interest rate environments, we can have positive market returns and as well as that steady market return. So we think that we're going through a transition and we're going to get there. But if you look at those years of 87 through 90, in fact, wasn't until 1990 that there was even a year that ended down. So just wanted to provide some insight and historical numbers and something to think about. So any questions, always feel free to reach out. We'd love to talk about ways that we can kind of mitigate the bond market right now and approaches to getting out of this, temporary hole we're in.